All right, let's jump right in. One of the questions I hear all the time is, how often should I rebalance my portfolio? Like once a year, every quarter? And look, it's a fair question, but it kind of starts in the wrong place. The real secret to long-term success isn't some magic rebalancing schedule. It's about a complete shift in how you think about investing. It's about going from being a passive passenger in the backseat to being the pilot, the CEO of your own financial future.
Really think about it for a second. What's actually driving your buy and sell decisions? Is it a repeatable, logical plan with clear rules? Or is it just a gut reaction? You see a scary headline, you get a hot tip from a buddy, or you just get that knot in your stomach when the market lurches up or down. For a lot of people, if they're being totally honest, their strategy is just hope. They hope they bought the right stock, hope it goes up, and hope they'll magically know when it's time to sell. But we're about to see why hope is absolutely not a strategy.
Now this quote, this nails the mindset of a professional. See, pros operate with a plan. They're prepared. They already know the market can go up, down, or sideways. And guess what? They have a game plan for each of those scenarios. It's this calm, disciplined approach that's the polar opposite of the emotional roller coaster that traps so many investors and just crushes their returns.
And here's where we see the two paths, side by side. The emotional investor is always reacting. They're a passenger just getting tossed around by whatever the market feels like doing that day. They buy high when everyone's excited, and they sell low when everyone's panicking. But the systematic investor? They're proactive. They have a process they follow every single time. Their decisions are driven by clear criteria, not feelings. And the most important part? They manage their risk before they ever put a dollar to work. They're in the driver's seat. Today, we're building the system that puts you there.
So, here's our game plan for this explainer. First, we're going to talk about the problem of trying to invest without a compass. Then, we'll introduce the 4 pillars. This is the framework that's going to become your new guide. After that, we get really practical with a step-by-step weekly routine. From there, we'll do a deep dive into the pro's risk toolbox, and we'll wrap it all up with a really powerful mindset shift, treating your portfolio like a business you own.
Okay, so if we want to move from being lost to being systematic, we need a reliable framework, right? So let's get into our first big section and introduce that framework, the 4 pillars. This is going to be your new compass for the markets. And this isn't about some secret formula or magic trick. It's about building a complete 360-degree view of any investment you're thinking about. And here they are. First up, fundamental analysis. This answers the question, what should I buy? Simple. Second is technical analysis, which tells us when is the right time to buy it. Third is cash flow. Think of this as the business plan for the trade, the how. And finally, risk management. This is the big one, the most important pillar of all, and it's all about how to survive. Put them all together, and you have a rock-solid checklist for making smart decisions.
All right, let's break down pillar number 1, fundamental analysis. I want you to think of yourself as a detective or maybe a home inspector before you buy a house. You're trying to figure out the real health and strength of what you're buying. We're not talking about the stock price today. We're talking about the company's actual intrinsic value. Is this a strong business? Is it growing? Does it have an edge over its competition? This is where you do your homework.
Now, you've got to look at fundamentals on 2 different levels. First, there's the big picture stuff, the systemic view. What's the whole economy doing? Are interest rates going up? Is inflation a problem? Then you zoom into the company-specific level. Is this particular company actually making more money? What's its PE ratio? That's kind of like its price tag compared to its profits. And even better, the PEG ratio, which asks, okay, what's the price tag compared to how fast it's growing? You really need both views to see clearly. Let's move on to pillar 2, technical analysis. So if fundamentals tell us what to buy, technicals tell us when. This is basically the study of supply and demand, of market psychology, all drawn out for you on a chart. We're looking at price action and trends to figure out what the market is actually doing with a stock, not just what it should be worth. Now, it's not a crystal ball, but it's all about playing the probabilities and improving your timing.
Pillar 3 is cash flow, and this is where we get down to business, literally. This is the business plan for your investment. You'd never open a coffee shop without a plan, right? Your investments shouldn't be any different. So before you even think about clicking buy, you have to define 5 key things. 1, your entry point. 2, a realistic price target. 3, your exit plan, your stop loss if you're wrong. And from those, you get number 4, your potential reward, and number 5, your potential risk. Every single trade needs this plan, no exceptions.
And that brings us to pillar 4, the bedrock that everything else stands on, risk management. Look, pros think about one thing above all else, staying in the game. They know for a fact they're going to have losing trades. Everybody does. The whole key is making sure that no single loss or even a string of losses can knock you out for good. Your first job isn't to get rich, it's to survive. Think of your capital as oxygen. Once it's gone, it is game over, no matter how great your next idea is.
Okay, so we've got our compass, the 4 pillars. But a compass is pretty useless if it just sits in a drawer, right? You have to actually use it to navigate. So in this next section, we're going to switch from the what to the how. We are going to build a simple, repeatable, weekly routine that turns you from a gambler into a portfolio manager.
And the logic behind this routine is what's called a top-down approach. It's just common sense, really. You start by analyzing the big picture. Is the overall market tide coming in or going out? Then you drill down to see which specific sectors are the strongest. And only then, at the very end, do you look for individual stocks that are flowing with that stronger current. It just makes sure you're swimming with the tide, not fighting against it.
So here it is, the 6 steps you do every week. Number 1, you analyze the broad markets. Look at the S&P 500, the NASDAQ. What's the trend? Number 2, you check the news and economic calendars. Any big meetings or reports coming up? 3, you manage what you already own. This is like triage. You check your positions, you trim some winners, you cut the losers. 4, you start looking for new opportunities that fit your outlook. 5, you write everything down in a journal. This is huge for learning from your wins and your losses. And 6, every so often, you zoom out and review your big picture plan.
So when we talk about that first step, analyzing sectors, this is a super practical tool the pros use. These are the ticker symbols for the 11 major sectors of the economy. By watching these, you can literally see where the big money's moving. Are they pulling out of aggressive stuff like technology, the XLK, and hiding in defensive things like utilities, the XLU? This sector rotation gives you massive clues about the health of the market. All right, now for our third section, we're going to zoom in on what I believe is the single most important topic in all of investing: risk management. This isn't just about playing defense. This is about making sure you can survive the bad times so you can be around to thrive in the good times. This analogy is just perfect. You can't control the market. You can't stop a crash. That's the Titanic hitting the iceberg. But you have 100% control over your own preparation. You control whether you have an exit plan, a lifeboat. You control how much of your money you put at risk on that ship in the first place. See, the problem isn't the iceberg, it's getting on the boat without a plan to get off.
So what's actually in this toolbox? First and foremost, position sizing. This just means you decide ahead of time to never risk more than, say, 1 or 2% of your entire account on any single idea. This one rule alone can save you from blowing up. Second, stop-loss orders. That's your predefined eject button that gets you out automatically when you're wrong. Third, owning things that don't move in lockstep with stocks, called non-correlated assets. And fourth, more advanced stuff like hedging, which is basically buying insurance on your portfolio. All of these are active skills that you control.
And this chart shows you exactly how powerful that idea of non-correlation can be. The VXX is an investment that tracks market volatility. You can basically think of it as a fear gauge. Now, usually when the stock market drops, fear goes up. So as you can see here, while the S&P 500 might be down, an asset like the VXX can actually make money, which helps cushion the blow to your overall portfolio. It's a buffer. Okay, we're in the home stretch. In our fourth and final section, we're going to tie all of this together with the most important mindset shift you can make. We've got the pillars, we've got the routine, we've got the risk tools. Now, it's time to stop thinking of your portfolio as a bunch of lottery tickets and start treating it like a business that you own, operate, and manage as the CEO.
And that brings us right back to the question we started with. So, how often should you rebalance your portfolio? With this new mindset, the CEO mindset, how do we answer that? I mean, how often does a CEO review their business operations? Once a year? Once a quarter? The question itself just feels way too simple now, doesn't it?
This is the CEO mindset in a nutshell. Think of every single stock in your portfolio as an employee you've hired. Now, if you hired someone to do a job and they consistently fail to perform, would you wait a full year to fire them? Of course not. You'd review their performance, and if they weren't cutting it, you'd let them go. You have a duty to your business and its shareholders, which is your family, to cut what's not working. The exact same logic applies to a stock that's failing.
This table really pulls the whole journey together. You can see the evolution of an investor right here. Rebalancing just based on the calendar, once a year, that's a totally passive mindset. Rebalancing when something drifts by a certain percentage, that's a bit better, but it's still reactive. The pro approach, the CEO mindset, is proactive.
The trigger for making a change isn't the calendar, it's a failed rule that you discover during your weekly review. Has the stock broken its trend? Have the company's fundamentals gotten worse? That's your trigger. You're not rebalancing anymore. You are actively managing your business.
So we'll end with this. The answer to how often should you rebalance is that you review your business on a weekly basis, and you take action whenever one of your employees is no longer meeting the criteria you set for it. It's a complete shift from letting the market push you around to you taking control based on a clear system. So the final question really isn't about a schedule, it's about your role. Are you going to be a passive passenger, just hoping for the best, or are you ready to step up and be the CEO?